Volunteer Firefighters and Seven Plan and Trust Board meeting dated February 10, 2021 at 10:02. This will be an electronic remote participation meeting being go to. And let's start with roll call. Trustee Soriano.
Here.
Trustee Rosenblum.
Here.
Trustee Nippen.
Here.
Trustee Foster.
Here.
Trustee Miller.
Here.
Trustee Hamilton.
Here.
And I am here. So all are present. So thank you for attending today. Okay, next item was public comment. I talked to Shazia earlier and there was no public comment, so we're good there. Minutes from the November 11, 2020 meeting. I would need a motion to approve and a support.
I'll move it.
To approve the minutes from November 11th.
Support.
Okay, can you tell me who just did that?
Hamilton, I don't know who supported.
Rosenblum support.
Rosenblum support, okay. Any discussion on those minutes? Okay, let's do a roll call vote on that. Trustee Hamilton?
Yes.
Trustee Rosenblum?
Yep.
Trustee Miller?
Yes.
Trustee Foster?
Yes.
Trustee Nippen?
Yes.
Trustee Soriano?
Yes.
And Trustee Melzik, yes. All right, requirement requests, we have two this time. And it's two that were here for approximately 10 years, and we thank them for their service. And can I get a motion and a support?
Move by Foster.
Motion by Niffen.
Support.
Support
Foster.
by Foster. Okay, any discussion? Okay, roll call. Trustee Nippen.
Yes.
Trustee Foster.
Yes.
Trustee Miller.
Yes.
Trustee Hamilton.
Yes.
Trustee Rosenblum.
Yes.
Trustee Soriano.
Yes.
And Trustee Melzik is a yes. Item approved 7-0. Okay. We will go on to regular business. And that will be Graystone Consulting presentation. Tim and Amy, welcome, and you're on. Shazia, are you able to do the presentation or do we need Bob to do it? You're on mute, Shazia.
Okay, I am showing poor network connection.
Okay.
So I'm not sure how long I'll be on.
Okay. All right. So I think Bob, you're going to have to help Tim, and I don't know, Tim, if you have page numbers or what.
I do. I have page numbers, so I can call those out.
Okay.
Okay, and I also managed to get the 4 additional ones. If you need those,
thank you.
I can bring those up individually.
Okay, great.
Would you like the presentation up now?
Yeah, if you want to pull up, the first page would be page 14.
All right.
And hello, everybody. Happy New Year. We're going to kind of review a little bit about the markets because things have definitely been changing, especially since the election. We want to point that out to you. Amy's going to catch up on performance, and then we have some education to do around private equity and private real estate, which came from your last meeting and the asset allocation work that we did.
All right, 1 second.
Sure.
Looking for page numbers. Everything's tiny.
One more.
Keep going. right there.
Oh.
If you could back up one. Nope, move forward one. Okay, that's it, perfect. And I don't know if anybody else can see that, and I don't know if there's any way to make it any larger, but
If I make it larger, it starts pushing things off the bottom of the screen.
Okay.
That's about my max, I think.
Okay. So what you're seeing there is this is the Russell style and market capitalization indices. And as I mentioned before, since the last time we met, we've seen some changes, and they really come after the election, because prior to the election, the market was worried really about three things: the election itself, the the virus, and then stimulus. And let me kind of handle all those and then say why that probably changed some of the numbers you're looking at here. In that first, in terms of the election, we got through the election itself, and then there was the runoff in January where the two Democrats took the Republican seats. Some people had said that might cause a 5 or 10% pullback in the market. The market seemed to deal with it fine, so that risk kind of has gone by the wayside. In terms of the virus, obviously cases got escalated. We're continuing to deal with that on a day-to-day basis, but there were the announcements that came out before year-end about vaccines, and that definitely has the market thinking that, the end is in sight in terms of getting people vaccinated and being able to reopen the economy. And on the third front, stimulus, we had finally at the end of the year, after doing the big stimulus package right after March, we had nothing done through the election, but then at the very end of the year, there was a stimulus package done. And I think many investors believe that with the new administration in office, there's probably going to be more stimulus that will be done here in the not too distant future, and that's been helpful. And you'll see that on one of the graphs that we show you as well. What that has meant is leadership is starting to change in the market. So if you look at this chart, there's two things to take from it. One, those dark blue lines, those are the last quarter. And you actually saw value finally as an investment style outperform growth. Now for the full year, value was only up about 2.5%, whereas growth was up 38%. So it's getting pretty stretched in terms of growth versus value. You can see that on the chart as well. Those are those light blue bars on there. Okay, and whether it was large, mid, or small, that went on. But one thing you do see reversing a bit as well in the fourth quarter in those darker blue lines is the smaller you go, the better the performance. And so two trends that we think are taking hold now because of the way this recovery is happening versus the last one after 08-09 is you will start to see value outperform growth, as we saw in the fourth quarter, and you will see small and mid outperform large, which has been the opposite since the recovery of 08-09. If you could move one page forward. This gives you a look at the sectors. And I would tell you the spread was even wider than this, but you can see anything that was more economically sensitive really took it hard in the first part of the year. But they started to recover, especially in that fourth quarter period after the election, as we got through some of those risks or worries that the market had. Our view, though, is, as I said, value does better. So the more cyclical or economically sensitive areas like energy, real estate, financials, industrials, materials, they start to take the lead. That's what usually happens when you come out of a recession. You go to the more cyclical areas. And this recession, we think, is different in the fact that because of what the Fed has done, because of the stimulus that has been done, we will see higher growth. We will see movement upward in interest rates, which we started to see, and we'll see more inflation. That was not the way the recovery played out in 08-09. I've got a slide for you to see that, or a comparison of that as well. But you can see what was dominant: consumer discretionary and technology. Some of those areas are getting a little frothy, a little expensive. I'll touch on that in a bit as well and use a historic marker to say why we're a bit worried about those areas of the market. If you could move forward 5 pages. good. Thank you. This is giving you a look at why we think this recovery is different. So we were one of the first to start using the idea that this would be a V-shaped recovery. More people have kind of come around to that idea, but it's easy to say. What you need to do, I think, is demonstrate that and show why that, is happening. So this is, as the chart says, retail sales. And you can see they plunged in the first part of the year when we shut down the economy. But then the Fed took interest rates just about to zero, started doing quantitative easing, buying up securities, assets, and then we had the big care package stimulus. And what you saw happen was consumer spending, right? So our retail sales started to move up a lot, and that's that V shape that we see. And it's important because the consumer is such a big part of our economy to see that they're spending and they're feeling healthy. But beyond that, it just didn't get back up to the line. It went above the line. So there's what we would call incremental growth in that. You do see that it started to crest. That's when the worry came in that as the virus was taking longer, we wanted to see, or the market wanted to see a little bit more stimulus done, right, to kind of tide us over till we can get even more reopened than we are. Now, how is this different? The gold line, that's the last recovery we had, the 08, 09 as I call it. And what you saw was retail sales maybe didn't go down as much, but they went down. And then look at how long it took it to recover. We did not utilize the same tools with the same speed that we have this time around. And so the economy really looked, the recovery, more like low growth, low inflation, low interest rates. And that meant different leadership in that type of environment, which has kind of carried us through here more recently, but we think is changing, as I mentioned. If you could go one page forward. This is why we think you will see potentially higher rates and more inflation. This is money supply, M2. And you can see that blue line here with what's been done has shot up. You can look back over time, and it's well above other levels. This is what makes us believe this recovery is going to have more growth, more, higher interest rates, and higher inflation. And that's what the market is starting to move toward because it's forward thinking, and that is completely different than what had gone on before. And inflation, should we get it, and higher interest rates, that is not as good for what has been market leaders before, particularly high PE momentum growth names. And that's why the value names, more economically sensitive or cyclical names, are starting to pick up and do better. If you would move one page forward. This is showing you that, if inflation doesn't move up too quickly or interest rates move up too quickly, stocks are a good way to hedge against that. Bonds, it's going to be difficult for bonds, obviously, right? Except for tips, potentially. But you can see on this chart what's been going on. Cyclical stocks here more recently have started to pick up their performance. That's that change in leadership because people are starting to realize, some investors, that as we're talking about, this will be the areas, or these will be the areas that will be rewarded. Their valuations are cheaper. They're more economically sensitive, so as the economy moves up. And this can be said for small and mid-cap companies, too. I've got a chart on that in a moment to take a look at. But this is where it may get more difficult. When you look at the Russell 1000 growth, you see PEs on some of those companies, 31 times earnings, 69 times earnings, 56 times earnings, for the Netflix of the worlds and the Amazons and all that, which have been the darlings of the market. But those higher PEs are going to be harder for them to justify if we see, interest rates and inflation moving up. That's how the market deals with that. If you'd move to the next page, or excuse me, 2 more pages. This is what I was talking about with small and mid cap. Going into a recession, and we've laid out recessions back through time, you can see that blue line comes down. That's small cap stocks. Small and mid cap, I could take those together. But what you see coming out of a recession is that they tend to move up and do really well. And so that's one of the areas, one of the themes that we're looking at. Large cap has been dominant for a while. We think that what you'll see is small and mid cap will start to take leadership, and we've already started to see that here more recently, like in the fourth quarter. If you would move ahead another couple of pages. So this is a historic chart that may be a little bit sobering, but we think it's important. You can see the dark blue line. That is the ratio between growth and value as measured by the Russell 1000. And that was the period of 1995 to 2002. For those of you who remember that period, when we got to the end of the 90s, they called it the tech bubble. The market was very focused on certain sectors. The market was very focused on certain names. PEs got very high, but people said they were justified, and they kept buying those names. And then what happened was that bubble burst, and we went the other way. And you can see that blue line came down significantly. And unfortunately, it also meant the market was negative in 2000, 2001, and 2002. Being in value, right, was a way to defend against that, and value made up a lot of lost ground during that period. So to support that blue line, we've put in now a light blue line. That light blue line is now from 2015 to present. And what you can see is it got even more stretched. It's starting to turn over because of what we've seen here more recently, but some of those same conditions still exist. So let me give you some statistics here on the Russell 1000 growth. The top names within the Russell 1000 growth, they represent about 41% of the benchmark. That's Apple, Microsoft, Amazon, Facebook, Tesla, Google, and Netflix. And those have all been incredible performers, but they are a huge piece of that benchmark. And if you look at their PEs, I kind of mentioned those before, 31, 32, 69, 24, Tesla, 202, Google, 30, Netflix, 56. Those are elevated PEs. And then if you look at sectors, technology is 45.33% of that benchmark. Consumer discretionary is almost 17. Between those two, it's 62% of the benchmark. That's what gets the line like it is. That's what gets growth outperforming so much and then becoming such a large piece in some of these singular names. So it's concentrated by sector, by name, some high PEs, and the difference between growth and value is very elevated. And so our view is, as we talked about, this is a different recovery, and this rolls over. What we hope is the conditions now economically are different than they were back, in 2000, 2001, and 2002, and we will not see growth go down, that hard. And it may underperform, and the difference between growth and value may, be narrowed. That's what we think, but we hope that it isn't because growth goes down so much. But we do believe there's risk in that part of the market. Could you move one page forward, please? And then one of the last trends that we see is the last recovery with the dollar rising, with the previous administration that we had in office over the past 4 years. What we definitely saw was U.S. did better than international. Now, what we are seeing now is what we would call global reflation. So we expect global commerce to pick up. We started to see signs of that. We expect interest rates and inflation to pick up globally. And in the past, historically, that has meant that international and emerging markets do better. We also have the dollar has been coming down recently. And we also know that there's been a change in the White House, which may mean a different policy that might be a little bit more friendly from an international perspective. So in the fourth quarter as well, you did see international start to really pick up, emerging markets start to pick up, and they've continued that this year. So if you think about those trends that are different, because this is a different recovery and we're in a different part of the cycle, it's value probably doing better than growth. It's small and mid doing better than large. It's international doing better than U.S. and emerging markets as well doing better than U.S. Those are the things that we see changing because of the type of recovery that we see. And so I wanted to take the time with those pages. Now, you don't market time that. You don't throw everything out of growth and into value. But tactically, these are areas that you start to look at potentially overweighting, and some of the other areas that maybe are expensive, underweighting those relative to where they've been previously. Okay? The next page would be, if you move ahead 13 pages, okay, if you want to stop right there. I'm going to turn things over, and Amy's going to pick up on performance through the fourth quarter, and then I'll come back to do the educational slides on private equity and private real estate. Amy?
Thank you. So, again, we'll kind of look at what happened in the portfolio. I think what you'll see and identify is those trends that Tim was talking about, particularly late in the year, show up in a big way in this portfolio, and that's really the biggest benefit to the positioning right now. We'll talk about that. We'll talk a little bit about some areas that we're highlighting that we'll likely come back to you and have more discussion on. How can we tweak this portfolio, continuing to push it in the direction that Tim was talking about. So if you look on this page, you'll see in that quarter to date column, there's a big quarter for overall performance, not only in the markets, but for this portfolio. So we had about 10.5% return in the fourth quarter alone, certainly pushing us well into the positive territory year to date at 10.26. You'll see in terms of assets, so we started the year at 11,121,000. We had about 713,000 come in terms of inflows. The investment earnings were over 1.2 million, so we ended the year over the $13 million mark. So positive movement in the portfolio, certainly in that fourth quarter, and that really talks, I think, a lot about the areas that Tim highlighted with those cyclicals. That plays in very well to the way that this portfolio is positioned and really has been for the long run. Outperforming in the fourth quarter is the trend that we expect to see. And if you flip to the next page, we'll kind of talk a little bit about the positioning and why that is. So as Tim had mentioned, there's some asset classes that did particularly well. When you look in this portfolio, the allocation that you have in terms of equities, so 9.2, almost 9.25 of this portfolio is in equities. That's 71%. So that overweight to equities certainly was a benefit. If you look below that, you'll see U.S. equities at 50%, basically 6.5, almost 6.6 million. And then you'll see international at 2 million. So that exposure over 15% to international was one of the biggest outperformers and tailwind for the portfolio in the fourth quarter, kind of push that performance forward. Same thing with emerging markets. So having 5% of this portfolio in emerging markets, extremely helpful in terms of performance generator. You'll see we have about 5.4% in cash, and that'll be a topic of discussion for us kind of going forward. And just to give you a little bit of a history on when this plan was first set up, there was an existing portfolio of all government and basically mortgage-backed securities. So that's where these assets kind of evolved from, was an existing portfolio. You will see that as a part of the $2 million in fixed income. So we kind of inherited this portfolio of existing government bonds, and rather than sell everything and then buy a bunch of government and corporate bonds back, the process was this portfolio was full of gray bonds that we couldn't go out and replicate in terms of yield. Let's continue to hold them. And that was kind of the mandate, hold them, let them roll off and roll down. So what happens is, as these bonds start to mature, obviously they flow into cash. So having 5.4% in cash, I think probably is a discussion we need to have a little bit more clarity around. The target for the overall plan in terms of cash is 5%. I think we want to circle back when we talk about asset allocation, what's the right place to go with this portfolio, is that process of the bonds maturing, having those reinvested, and then what's the right amount of cash to have in this portfolio. So of that 2 million, there's about 775,000 of that is in those existing bonds that are going to continue to mature at a more rapid pace coming up here. And then you'll see in terms of alternatives, there really truly aren't alternatives in this portfolio. It's the way that they get classified. Real assets is real estate. So publicly traded real estate in this portfolio is about 1.5%. And then that absolute return asset, it is just BlackRock. It's a strategic income fund. It's a bond portfolio. It's really part of the fixed income. But because it has a target of an absolute return objective to it, that's why it gets thrown in that bucket. But it really is part of your bond portfolio in that category. The next page takes that same information, breaks it down a little bit further. So where you'll see U.S. equities, international emerging markets, all the same information, a little bit more broken down here between fixed income. So those bonds that you see are in that ultra short or short-term fixed income. And then you'll see this big bucket of U.S. That's Western, that's the individual bonds. And then you have exposure in this portfolio to inflation-linked securities. Also important. We talked about the fact that with rising interest rates and with a pickup in inflation, that buffering a portfolio and insulating it, potentially one of the biggest risks that we see is around what's happening in the bond market in a rising rate environment and with inflation. And we want to make sure that we've got this part of the portfolio right and positioned so we're not taking too much interest rate risk and looking at suffering of principal in that portfolio. So having inflation-linked securities is an important piece. And then below that, again, you'll see the breakout between the real estate, publicly traded real estate. Again, this isn't private real estate, no alternatives. And then the BlackRock portfolio. And then in the next page, we'll kind of do the highlights of performance. So again, in that very first bucket, this is what's called the consulting group advisor. So that's where the biggest diversification comes in. We actually have the individual bonds we talked about. We've got BlackRock in there, but you have your indexes. So your equity indexes are in here too. Overall for the year, that diversified portfolio up about 11% on a net of fee basis. Below that, you'll see Delaware. And this is another part. In addition to a 5% target cash, one of the other positions in the portfolio that we'll likely come and have a conversation about is this Delaware large cap value. So US value, you'll see there down 1.7 for the year, when value as an overall, we already heard, wasn't the best outperformance for the entire year. Certainly had a very good fourth quarter. That's the cyclicals outperforming growth. You can see that when you compare it to Winslow down there. So you're looking at the return differential. We finally saw that tip. And at the same time, we're continuing to watch Delaware. We want them to have outperformance in that asset class. So stay tuned. In terms of positioning of Delaware, it is more defensive. The weightings that they had in terms of financials, they actually were underweighted financials. When that took off towards the back end of the year, that's what you see in the benchmark. That was a participant in also some of those consumer discretionary. So think about the fact that we spent most of the year at home and the moment that we were able to go out and spend, again, part of what Tim was talking about, that's that rotation out of the technology, and now we can go out there and spend our discretionary dollars. And that part of the market took off, and that was an underweight for Delaware as well. So a couple of pieces there in terms of that manager we are paying very close attention to. Expect something a little bit more forthcoming from us on Delaware. The Ball and Gainer portfolio is a dividend grower portfolio. And again, you'll see that participation in the fourth quarter. Winslow is your large cap growth manager, up 36% for the year. And then you'll see mid cap and small cap up in the double digits, 20% plus in the fourth quarter. We think that continues in terms of the trend. And the international, as I said before, being one of the biggest contributors to that performance in the fourth quarter. You can see it laid out there, whether it's the international growth or international value, really important in the portfolio for performance in the back half of the year. The rest of these slides really take it to yet another layer of detail. So you could see the breakout between positioning for individual bonds and everything else. I'm not going to take you through the weeds on that stuff, but I will certainly open it up in terms of questions, comments on the performance and the managers that we have, kind of the direction that we're thinking we'd like to go with the portfolio. And you'll see that we'll have that conversation more with the rebalance as well. No questions? You want to talk about rebalance while we're here, or you want to go into some of the educational stuff, Tim?
Let's go to the rebalance page, Amy, if you would, for just a second.
Sure.
I just want to kind of touch on asset allocation before we go into some of the educational material.
So
that would be, you know how to get there, Amy, or you're not controlling it?
I'm not controlling it, but that one I think was a separate attachment, just kind of a one-page.
Hey, Bob.
Yes.
Can you go to about halfway through the document? It's actually page 75 of 150 on the PDF.
Yep. Bob, you got it exactly right. Thank you.
Keep going. I think you went the wrong way.
So as he's getting to that page, what we wanted to look at is the overall asset allocation. If you remember at your last meeting, not only did we do the asset allocation work, but we talked about the fact that because fixed income was not keeping pace with equities, as equities ended up, coming back as strongly as they did throughout the year.
Tim. Hey,
oh, sure.
Go up. Go where you were before.
Hey, Rob, I can share the screen if you want me to.
Okay.
Yeah, it's the 75th page.
If we could just bunch all of the disclaimers at the very end, it would make life a lot easier.
Yeah, a lot easier.
This section and that disclaimer, that section and that disclaimer.
Are you working on that, Shazia?
I need you to make me the presenter.
Oh, that will help, won't it? There you go. Always looks so easy in the training video, doesn't it?
Are you able to see it or no?
No.
Nope.
Now I have the 4 separate files. Is it one of those?
It's the main file. It's literally page 75. It's like Bob, can you not tell what page you're on, like when you're doing it?
Yes, hold on. Let's see if I can.
Yeah,
Okay.
That's it. Perfect.
There you go. So, as I was saying, when we did the asset allocation work, we also looked at your overall asset mix, and we said that we were in violation of the low end on fixed income. And that's because not that you were necessarily pulling money out of bonds, it's just that bonds were not keeping up performance-wise to many other asset classes. We noted at the time of the meeting that your range around your target on fixed income had a lot more room on the upside, not as much room on the downside. So our recommendation at the time was maybe to give yourself a little bit more room on the downside and bring the low end down to maybe like 20%. And that would mean that you would be in line. And then from a longer term perspective, so this isn't just, fixing that, is the idea that we probably would be looking at fixed income in our asset allocation work and saying those assets would be better served in other areas, right? Where we might get higher rates of return, we might be able to keep the risk down, we might be able to keep correlation down. So bonds, if you remember from that asset allocation study, I think our projection for the next 7 years was for bonds to make like either 1.7 or 1.9%, not very much. And based upon what Amy and I have laid out today, if we're in an environment of rising interest rates, right, and rising inflation, that's not going to be easy on bonds. That's why I think our expectations for bonds are so low in terms of our capital markets assumptions. So,
hey, Tim, Tim, I don't mean to interrupt, but based upon that, I did speak with Lori Bloom, our attorney, and this would be a discussion for our board, that there's no reason why we can't move our lower range from 25 down to 20%. So is that Tim, and you and I haven't discussed this, but is that something that we should discuss as a board today to talk about moving it down to 20%?
Yep, I think you should discuss it and bring it in the form of a motion as to whether you want to do it or not. We showed you here a rebalance that would end up putting money into bonds. That's only to get you in line with your guidelines. We're not really recommending this, but if you don't want to spread out your range, then you would probably have to do something like this, because we've been outside of that range on fixed income on the low end for a while.
So before you move forward with the rebalance, I guess I'll open it up to the board and want to see what people think of from last quarter's conversation and from everything we've heard today about where bonds are headed. Do we want to lower our lower end from 25 down to 20%? And I'll open that up to discussion.
Yeah, I think it would be a great idea. Take advantage of the current conditions, and that's just the exposure, I think, is more on the negative side than anything. I think there's some great opportunity going into this year. So,
okay. Thank you, Al. Anthony, did you want to say something?
No, I agree with Al. I think that makes sense. I appreciate the breakdown of the recommendation. It sounds good to me.
Okay. Any other board member want to discuss it before we maybe put a motion on the table? Chuck?
I just think the more flexibility we have, the better, all the way through. So there's no reason not to.
Okay. Mark, David, or John?
Will this require changing our? Will this have to go through council to change our financial plan, or is this strictly our jurisdiction?
No, this is our decision to make on our investment policy, and yeah, it would just be in the form of a motion, like Tim had mentioned.
Okay.
Hey, Rob, does that mean we have to edit the actual range of that policy for that particular asset? Is that how
Correct.
that? Okay.
Yeah. So I think what the motion would be is that our motion would be to move our fixed income range from 20 to 50%, where today is 25 to 50%. Tim, is that correct?
That's correct.
Okay. Does that make sense to everybody? I think so, right? Okay. I'm seeing nodding. I'll make that motion to change our asset class for fixed income from 25 to 50 to 20 to 50. And I would need a support on that.
Support.
Support by Chuck. Any discussion? I know we've hit it pretty hard. Okay. Well, let's vote on that. Trustee Niffen.
Okay.
Trustee Foster.
Yes.
Trustee Miller.
Yes.
Trustee Rosenblum.
Yes.
Trustee Hamilton.
Yes.
Trustee Soriano.
Yes.
And Trustee Melzik. The motion passed 7-0. So, Tim, based upon that, you have a different plan for us for today, or do we not do this rebalance because we can keep the equities where they are?
So that's why I wanted to touch on this page, because that means this rebalance really is moot, because we would not be putting money into fixed income with the change that you've made. However, Amy pointed out you do have some cash. That cash we would like to put tactically into some of those areas that we said we think, are going to be and have started to show market leadership, value, small and mid, international, emerging markets. So what we'd like to do is come back to you with a rebalance plan that puts some of that cash to work in those areas that we've outlined today.
Hey, Tim, I guess let me ask you, we meet quarterly, and I'm thinking that we should be getting that money to work now versus 3 months from now. Yep. So what do we do?
So what other boards have done, Rob, that I've sat on, is they'll say, okay, maybe the chairman and the secretary or whatever on behalf of the board will get the authorization to review the rebalance plan as we've outlined it, right? Money going into those areas that we've outlined today that we think make sense from cash, and then approve it, and then we can work with the city to carry that out.
Okay.
So that you don't have to wait till your next quarterly meeting potentially.
Okay. Does any member have an issue with that? Because I think the idea would be to take advantage of time in this case. The other thing I wanted to mention about the cash balance, I think we want to lower that close to zero, because right now the city contributes more than what the payments are for the volunteers in a given year. So we're actually, we the city are giving money into this plan each year. So there really is not a need for cash in this plan to make payments, I guess is the point I wanted to make. To move money around tactically, that's a different issue. But I agree with Tim, your comment, and I think we should move that money into the market, I guess is the point I'm trying to make.
And Rob, you bring up the last point that I was going to say about where we are now from an asset allocation standpoint. We used to see in many plans, particularly plans that were moving over from being mostly fixed income and then taking on some equity exposure, is that they would have a target of 5% cash. It was, kind of a conservative thing, a thought process that there might be some need for it. And it was probably done at a time when cash was paying a lot more than it's paying right now. Most of our guidelines now would have cash as a target of 0 and maybe have a maximum of, say, 5%. If cash builds up, right, it's okay, but you're not expecting to hold 5% cash on an ongoing basis, to your point.
Okay. And it's different than our ERS plan, where we're actually having to take money out of the plan twice a year to make payments to the participants. So I think this plan is a different situation.
Yeah, your cash flows are much different here than that. Yeah.
Right. Okay. All right. So Tim, do you need a resolution then, or just a thumbs up, or what do you need from us?
I would think you'd want a motion that at least says you want us to go back to the chairman and secretary with the rebalance plan, moving the money from cash into those areas of the market that we would recommend. And then you may even want to put into that motion as well, changing your target, right, from 5% in the guidelines to 0. Now that you might want to hold off on too, though, because we're going to be doing education about some of these other asset classes that we showed you before, and you may want to allocate that 5% target that was in cash to some of these others. So you may want to hold off on that one for a while. Your choice.
Okay. Can I get someone to do a motion for the first part, and let's just do the first part.
Yeah, I can motion that to remove the cash balance requirement from 5% to 0.
No, Chuck, I was actually asking for the other one.
Oh, you want to do the other one?
Yeah.
Sure, that one's good too. It's just for the chairman. It would just be the chairman and the, what did we say?
Secretary. Yeah.
Secretary?
Yeah.
All right.
I'll support it.
Okay, so I got a motion by Chuck and a support by Anthony. Was that right?
Soriano.
Oh, Soriano. Okay. Any further discussion? Okay, let's call the motion then. Trustee Niffen.
Yes.
Trustee Soriano.
Yes.
Trustee Hamilton.
Yes.
Trustee Miller.
Yes.
Trustee Foster.
Yes.
Trustee Rosenblum.
Yes.
Trustee Malzik, yes. Item passed 7-0. So, Tim, you think you'd be able to get that in the next week or so to us?
Probably in the next day or so.
Okay, perfect. Thank you.
Mm-hmm. Yep. So, we want to move along then to the educational pieces. That the first page of those would be 79.
Hey, Tim, I'm sorry. I just wanted to mention one last thing. So when you do that, for full transparency, I will send it to the whole board what the recommendation is too. So just so everyone knows that.
Yeah, absolutely. I think that makes sense.
Okay. 3 more pages over, you said?
Nope, you got the right one. Perfect, right there.
Perfect.
So we'll start off first by talking about private equity. And this is going to be kind of a macro view, or, it's not, we're not going to go through 20 different pages or whatever. This is your first step in education on this. But if you remember from the asset allocation study that we did, we saw a rate of return a little north of 11% over the next 7 years, with risk levels lower than all of the equity asset classes and a lower correlation to those equity asset classes. So what does that accomplish? It'll help your return. It'll help your risk go lower. And because it doesn't correlate, it does the same thing. But that doesn't mean private equity doesn't have any, warts to it. It does. And they've gotten better over time, but there's still liquidity issues within private equity, and there's fee issues with private equity. Okay, those we'll kind of explain and talk about as we go forward. This is just showing you the 3 types of private investments. You'll talk about 2 of them today: private equity and private real estate, the other being private credit. So if you want to move forward 1 more page. So, what is private equity? And this is really telling you how you would access private equity. So you can go into a private equity fund directly, and you're going to put your money with that private equity manager, and they're going to invest in a bunch of private equity investments, non-publicly traded companies, right? Or you could be in a fund of funds. And a fund of funds just means you put your money with a firm, and then they're going to get bits and pieces of different private equity funds. So you'll own, a certain number of those within a portfolio. Okay? Now, even taking it further, within private equity, there are primary funds. So first time they've gone in, they'll take cash and they'll make purchases of some private equity investments. What's become more popular recently is secondary funds. So that might be other private equity funds that have been out there that someone decides they want to sell their share in, and they can go out and pick up a secondary fund. You'll see later on why that might be advantageous. And then the third one down at the bottom, and this has come on more recently as well, is co-investments. So if there's a really large private equity firm and they take down a deal and they say, geez, we don't have enough money, or we don't want to spend that much money of our fund on this deal, they'll go to other private equity managers instead of taking it out to the public and trying to raise money that way. and they might get 4 or 5 other, usually smaller private equity firms to co-invest with them. But the idea is there's a lot of different ways for these either direct or fund-to-funds to access private equity. Okay? If you move one page forward from there, and so here is why a secondary private equity transaction might be attractive. I think this is the most important part here. You'll hear a term sometimes used within private investments, the J curve. What the J curve means, unfortunately, is if you're doing more primary investing, you put money into a private equity company, and it could go backwards, go down in value a little bit before it moves up because of the money that needs to be spent before you start to, it matures and starts to, come up in value. So one of the things about using a secondary that's already existing out there and has already gone through some of those initial stages is you can mitigate some of that J-curve effect. Okay? The second reason why you might like secondaries or people are finding them attractive is it takes out that kind of blind pool risk. So when you go to a primary fund, you know their track record, you know what they typically like to invest in, they'll tell you what they might be doing, but until they start investing that money, you don't really know what's in there, right? But a secondary fund, you see what's in there. You know what they're investing in. So you immediately have an advantage over maybe a primary there. And then investment strategies. Sometimes using these secondaries, you can mix them into a portfolio and get, more diverse strategies in a portfolio of private equity investments. So secondaries, which really were kind of sketchy before, have become a lot more popular recently for some of those reasons laid out right there. If you move forward one more page. Now, this is kind of the steps or stages of private equity. So many of you may have heard kind of that venture capital stage. That's what I described earlier. It's a company that's just starting up. They're raw, they're brand new, and that's in particular where you see that line on the chart above where it says venture capital start to move down a little bit before it moves up. That's that J-curve effect, okay? Now, the one thing that's good about venture capital, though, is if you get a good company early on, you can see your runway and your return is a lot higher. So that's why people would necessarily want to look at maybe venture capital because they get a bigger bang for their buck there, right? Now, if you move into the next stage, which would be growth capital, these are companies that have matured a little bit more. So they're further along, but they may still need some capital, right, to help them grow because really the goal of private equity is what? You want to take your holdings, dress them up, get them, to the point where they're interesting enough to do what? Take them public and sell them, right? That's how you're going to realize your gains ultimately. So in that growth capital stage, these are just companies that are further along. You can see you're not going to have as much upside there, but you obviously have companies there where you know a lot more about them than maybe a venture capital firm that has just started up. And then the last one, and this is usually where our clients don't typically like to buy into this area, is the buyout. And that is taking a company that's already public, buying them out and taking them private, fixing them up, and then taking them out hopefully public again somewhere in the future. That usually has a shorter time frame of turnaround, right? As the growth capital did, you're going to realize your gains, but you're probably not going to have as big a gains. And in many cases, those are turnaround situations. So more than likely, most people are that, most of our clients that we're working with like the private equity firms that are using venture capital or growth capital for the most part. Okay. If you could move a couple of pages forward. Page 84. So this is where sometimes it gets a little surprising, I think, to certain people. These are from 1990 to 2019, the returns for private equity, whether it's US based or it's globally based. And you can see those are some pretty good returns. However, what I do like is in our asset allocation study that I just referenced earlier, we didn't have returns even this high, right? We were talking more of returns, a little bit north of 11%. So are our returns that we expect for private equity over the next 7 years pie in the sky? I don't think so, because if you look over that long period, 1990 to 2019, they had returns higher than that. Now, what we've compared it against is the S&P 500 and then international stocks, okay? And, maybe international stocks at least should have higher rates of return from our asset allocation study than they had during that period, right? They're coming off a period where they've been out of favor for quite a few years. We think that's changing. But the S&P has obviously had some good results, and yet private equity beat both of those asset classes during that period of time. Where the surprise comes in is, in that box down below, look at the risk level for both of the publicly traded forms of equity versus privately traded. And the next slide, I believe it is, will show you why that is. So it's 2 pages forward to 86. One more. There it is. So I mentioned before, the warts that are around private equity are twofold. One, fees. Fees have been coming down, but fees are going to be more expensive than what you would pay a traditional asset class manager. The second thing is illiquidity. So if you look on that chart, the circle around private equity says you could be looking at a lifespan of 5 to 10 years. Okay? So you might get into it, and 5 years into it, you'll start to sell off some of those holdings, but it may take fully 10 years before they're all sold. Now, liquidity on private equity has improved a bit, but it's still not great. It's not an asset class you go into and say, oh, this is going to be as liquid as my publicly traded equities or my bonds or some of the other traditional investment asset classes. But that illiquidity is actually what allows managers over time to get those higher rates of return and have those lower levels of risk. Why? Well, because clients can't move around and come in and say, I want all out or all in quickly. What does that do? That gives them more time to let their investments set up and mature and harvest at better rates of return than being subject to people pulling money in and out all the time. And secondarily, that means you're going to get, because it doesn't price on a daily basis, it doesn't have that kind of liquidity, it still prices quarterly, but that helps reduce some of the risk to the asset class. And that's also what drives the fact that it doesn't correlate to the publicly traded asset class or other asset classes in your portfolio already as much. So the illiquidity, while it can be a problem, also offers some advantages, right? And you can see on that chart some of the other asset classes and what we'd expect in terms of their liquidity as well. Any questions on any of those charts? Okay, so if not, then we'll move on to private real estate. And that would start, the first page of that is 108. So this chart in the middle of this page shows you within real estate, there is, on the equity side, there's private and there's public real estate. On the debt side, right, there's private and public debt as well from a real estate perspective. We're going to be dealing with the box, that blue, darker blue box of private real estate. The public real estate would be REITs, real estate investment trusts, okay? And those have different parameters. You'll see some of that on the slide a little bit later on. If you move one page forward, so on this chart, what we're showing you is returns for private real estate. Now, what you'll notice is private real estate during this time period has not had as high a rate of return as publicly traded real estate, right? I think in our asset allocation study, we had a return somewhere in the area of like 9.5%, which is still attractive. But you can see during this period of time, publicly traded real estate did much better. But publicly traded real estate also, by that blue bar, the light blue, has more volatility to it as well. Okay? So the idea here, once again, with private real estate is that you get a rate of return that over the next 7 years at close to 9.5% would be attractive. It has less risk, because look at the low risk level on that chart for private real estate. But then the chart to the right also shows, look at how low its correlation is for the other asset classes. And that's part of the same thing with private equity and private real estate. It's a very good diversifier in a portfolio. Next page would be 110, so one page forward. The questions we usually get when we're doing education on private real estate are, wait a second, with COVID, it's basically shutting down, the economy, people working from home and not in their office, retail not doing so well. Where would you, invest even if you were looking at private real estate? So this chart shows the main groupings of where private real estate looks. First off, industrial. That has been doing exceptionally well given the new e-commerce economy. That has definitely done very, very well. And that's an area that many private real estate managers and public for that matter are focusing on right now. The other one is multifamily housing. That's done exceptionally well. I was just on a call with a client the other day doing these educational slides. They had actually heard from a private real estate manager, and they were talking all about within their community how multifamily housing was really growing and there was really good profits to be made from it. From an office perspective, which is just above that, that's really where you got to be a little bit more selective. So very high quality office space in areas, where geographically it's very sought after. That we have not seen suffer too much. And that brings in very good income. It's really office space in geographically less desirable places, or that's lower quality office space where that's what managers are avoiding right now. And then in the retail space, kind of the same thing. The mom and pop strip malls or malls themselves aren't faring as well, and those are areas they're avoiding. What we have heard from some private equity private real estate and public real estate managers is the new trend in retail is to find a strip mall that's anchored by like a high-end grocery store that'll bring people in, and then you can keep really good tenants in some of the space nearby. So there are some spots in retail and office. It's just probably a little bit more limited right now because of what has happened with COVID, and managers need to be careful there, whereas it seems like multifamily and industrial is a place that really is gaining a lot of traction. If you would move forward 2 pages to 112. So within private real estate, there's 3, I'll call them buckets. The first is core. And core is going to be less leverage, much better quality, higher tenancy rates, things like that. This is where, I'd say almost all of the assets and our clients have from a private real estate basis are invested. The returns there, right, are, as you can see on that chart, less than the other 2 buckets, but the risk levels are a lot lower as well. And as you saw from our study, we think going forward, our numbers were based off of primarily core real estate investments in our asset allocation study. The next bucket out, that's value add. Those are going to be properties that probably have a little bit more leverage, may need a little bit more tending to, may not be as high a quality as some of those core holdings. And because of that, you're going to get a little bit more return, but you're going to take a little bit more risk. What we have seen, or some of our clients have been interested in, is what got coined by another board as Core Plus. And that is really taking a core manager who's going to be 90, 95% in core that might have 5 or 10% in the value add. The last piece of it is the opportunistic. I would think of this as what you saw in the private equity as the turnaround. These are going to be properties that, are going to probably be much more highly levered, not as good a quality, going to really need to be fixed up quite a bit before they can be turned around. This might be someone bottom fishing in the office space area or the retail space, expecting that they've gotten to low levels and they'll turn around. This is not normally where any of our clients have been wanting to invest. And yes, the returns are higher, but you can see the risk is the highest of the three buckets. Okay? If you'll turn one page forward from that to 113. This is kind of showing you the same thing you saw before that goes on within real estate or private real estate, and that's that life cycle. And you can see there sometimes is a bit of that J curve here as well. That can be somewhat mitigated as well, though, because what we do see is there are open-ended private real estate funds, which sometimes will have lower fees and help you mitigate that time frame. So you'll get a rate of return off of those. You'll have better liquidity, and you're not in a situation where they're buying up properties and then selling them off, and it may take 5 or 10 years for that to happen. This is more typical for a closed-end fund, where you're going to give your money in, they're going to make those investments. They may get you a little bit higher rate of return, but you're probably going to look at a little less liquidity there. One other thing I should mention, and I should have mentioned this back on the previous page, in the core space, the other thing we typically see is you're going to get from those kind of core private real estate investments, much of the return is going to come from income, right? From leasing out the space and things like that with tenants and high, occupancy rates. So that's why also it helps to cut down some of the risk there as well. And then the last page is the next page. So here you can also find, like you can in private equity, secondary real estate transactions. And so it can add, over on the right-hand side there, you can see it can add additional diversification. It can help to flatten that J curve, right? You can have pre-identified assets. So like I said before on the private equity side, you would know what real estate, what buildings, what properties potentially are already owned within a fund that is secondary. And then you can see shorter time horizon, because those would typically, if you're buying something in the secondary, be buildings that or properties that someone's held for a while and maybe closer to being able to be liquidated and realizing your gains or some of your returns off of those properties as you sell them. So, thank you for your patience. I know that was a lot of educational material. Hopefully now, from a kind of top-down view, you have a good idea or a better idea of what private equity is, what private real estate is, why it may, why some of those numbers, I should say, from our asset allocation work came through the way they did, and why these asset classes are considered by other funds. There's no doubt you have to get comfortable with the idea of some loss of liquidity, potentially some higher, fees there. But remember, the fees that we showed you for both of these asset classes, those are net. That's the way they have to produce their fees, or their returns is after all fees in this space. So at this stage, what I normally ask boards is, okay, we've given you the primer on both of these asset classes. You've seen it through the asset allocation study, and we're interested in it based upon those numbers. the next educational step before you would make an investment, in our minds, would be to actually talk to managers in this space. Not multiple, but get a private equity manager to come into one of your meetings and speak to you, and get a private real estate manager to come in and speak to you, and not be selling you, but giving you an educational presentation. And we've been doing this with our boards because they then can kind of give you the nuts and bolts, right, of how they're going about investing, where they're finding things that are attractive, what they expect rates of return to be, what their fee structures look like, what liquidity looks like. So it's a good way, I think, to take that kind of last step educationally before you would ever start to maybe interview anybody to make an allocation potentially in either one of these asset classes.
Hey, Tim, just ideally, I got to believe this is just to plant the seed to replace that Delaware account that's been underperforming the last couple of years.
It may, what if you remember from the asset allocation study, and we would bring that back if you were to interview some managers, there was, we showed you mixes that could actually enhance your return, right? Lower your risk and be what we would call more efficient on a risk-adjusted basis. So that's where we would look again at what allocation. So there'd be some trimming from certain areas, right? And there might be adding into some other areas like this as well. Now, one of the other things to keep in mind too is these asset classes, many times you don't put all your money in at one time, right? You might put some in, they might call some over time, or you might use, as you do in some other asset classes, you may use more than just one manager. You might use a couple private equity managers or a couple private real estate managers to get further diversification. But that next step about where the money comes from, right? That's really based upon some of that asset allocation work. And this year, what we hope is our asset allocation studies, which were delayed last year because of COVID, should be ready this year in April or May. And that would be nice to look at those numbers again in conjunction maybe with you doing some further education on this to make sure the numbers still look as good, right, as we're trying to make a decision about whether to add to these asset classes.
So what's the board's pleasure? Do we want to take the next step and bring in a private equity and a private real estate, or do we want to do neither, or do we want to do one of the two? Any thoughts from the board?
Just to give you a frame of reference too, we do not let them come in and spend an hour each with you. We keep them to about 20 minutes. You've already had education on the asset classes, so we limit their time. If you want to ask them questions and they, could be in there longer, that's fine. But for their formal presentations, we do ask them to keep it to about a 20-minute time frame.
I would like to hear from both. Does anybody have any dissenting opinion on that?
I'd be in on that. I'd like to hear it.
I'd like to hear it as well, especially given that we're not, we're meeting once a quarter. We don't necessarily need the liquidity and that, sort of quick action, something stable and longer term, especially if it can provide some of these kind of returns, I think is certainly worth exploring.
Sounds good, Anthony. I don't disagree with you. It can't hurt to bring them in May. In looking at our May meeting, I don't think we have anything that's, we have that 2-hour window, so maybe it's a matter of, Tim, you said 20 minutes. If we have two different people come in and it's still educational at this point. And then that would be good timing with the asset allocation study to come back in too, I guess.
Yep. Good. Okay.
Okay. Any other thoughts from any other thoughts from the board on that? Okay. Good. Anything else, Tim and Amy?
Yeah, I know that was a lot today, but no, that is all we have for today's purposes.
Exhausted.
We could give you We could tell you that you're up over 3% this year. We could leave on that little note. So we're almost at 3.5%. Again, so we're adding the additional returns up 3.5 almost for the year to date.
Yeah, and speaking of that, at year end, I was looking with our balances as of December, just to tell the board, I calculated it at approximately 55% funding. So after we made those changes to the VFIP plan, we were under 50%. So it's been a nice little pull up, and so we're up to over about 55% funded. So that's a good thing. So I guess we can leave on that note. Again, thank you, Tim, and thank you, Amy. Appreciate you guys' time and efforts for us. Yep. Okay, moving on. I don't have any other business. Does any board member have any other business they'd like to discuss? And just give you guys a quick one other comment, I guess, is that we're putting together the data for the evaluation for GRS. So we're moving forward with that as well. And so that, I think that comes in the August meeting. So just more of a FYI. So other than that, I think we're good, and I think we can adjourn if everyone's good. Thank you, everybody, for your